Stocks eke out some gains with utilities and FMCG leading the charge while healthcare and metals lag, mid-caps underperform.
The government trims windfall taxes again on crude oil, diesel and aviation turbine fuel while the levy on petrol stays at nil. The move buoys sentiment for oil producers and refiners.
Hindustan Aeronautics tells CNBC-TV18 that it's looking at a big swell of orders in the next 6 months, while Sula Vineyards is upbeat on its big crop for this season.
PwC's CEO survey shows 73% see growth declining over the next 12 months, but Indian honchos are more upbeat. Tata Steel's TV Narendran is optimistic on China reopening. Bajaj Finance's Sanjeev Bajaj thinks the worst is behind, even as noted economist Kenneth Rogoff sees China's reshaping as a big opportunity for India.
Hello and welcome to Halftime Report. I'm Sonal Bhutra and with me is Ekta Batra. Ekta, good afternoon. Well, it's turning out to be a good session so far. We did see some fall from the top, but again, Nifty is recovered from those levels as well. So right now, above that 18,000 mark. So the next level to watch out for, of course, will be the 20-day moving average of 18,051. Across the board, we are seeing some buying come in. However, the mid-caps, they continue to underperform. So that index is down 57 points. A lot of stocks that have been focused on the back of earnings. We'll discuss that in greater detail. But for now, of course, in the absence of any cues coming in from the US markets, we have continued our up move so far.
Yes, absolutely, Sonal. Well, the European markets did manage to close higher, so that was a possible positive cue. But it is only one day of the US markets being closed, and we did see a lower FII as well as, DII buy figure which came through. So let's see what that trends. But nonetheless, we do have Mastex numbers, and the stock, in fact, is reacting negatively to those numbers. Where there is a revenue growth of around 5% on a Q-on-Q basis. Margins have been flat on a Q-on-Q basis, but the net profit has declined around 18.8%. We'll get Rima to talk more about the numbers, but as of now, the market doesn't seem to like what it's seeing in terms of Mastex performance, Q3 performance. The stock is at the low point of the day. For the markets, it's a lot about the banks today. So Federal Bank has given quite a positive outlook in terms of net interest margins going forward. Indices Bank is coming out with its numbers this week. So that stock is in focus, one of the top losers on the Nifty. So maybe some trepidation ahead of that. And a lot of results today. Bank of India from the results from the entire banking space. But besides that, ICICI Pru, Delta Corp, Mastec, which you can see is reacting to its numbers, and Metro. So we have a lot of numbers and a lot of news to focus on in the next 60-odd minutes.
Okay, all right. So that is all about the markets. But let's get stock specific now. Agrochemical major India Pesticides has announced launch of the herbicide technical product it is for their export markets and will be used in various industries as well. And it will be manufactured at company's Sandila plant for international markets. As I said, the stock is up around 1.5%. To understand what the opportunity here is, Dheeraj Kumar Jain, the CEO at the company, is joining us now. Mr. Jain, good afternoon. Thank you so much for joining us. You have launched and announced the launch of this new product. Can you tell us what is the opportunity size here? Have you already started delivering it to customers? You say it's for the export markets. So is it coming at a higher margin for you?
We have just recently commissioned the plant for this herbicide, which has a lot of export potential. And the first batch and the second batch are coming up now. And we have lined up with so many multinational companies for marketing of this product. And as opportunity-wise, we feel that we should be able to generate a revenue of about 100 crores per year from this product.
Oh, okay. So you're expecting, Mr. Jain, 100 crores per year from this particular product. Would that be the peak sales that you're anticipating?
No, this is not the peak sales. I'm taking an average out sales. When the peak capacity is achieved, it will go even up to 150 to 160 crores.
And where exactly is this, how many companies do you expect to supply this particular product to generate 150 to 160 odd crores? And like my colleague asked you, what might the margins be?
Yeah, see, we would be marketing this to various customers in Europe and in India. They have different market areas. And we already have lined up about 5 customers who are seriously interested in this product. and we are in the process of finalizing the MOUs with them. And as I said, the market, the potential for the revenue is about 150 crores when it achieves the full capacity. And the margins would be more or less similar to what we are enjoying presently, is around 22 to 25% in between.
Okay, so the margin profile is similar to the current profile that you have.
Yes.
Is it included in the export growth guidance that you told us earlier, Mr. Jain? The last time we had a conversation, 40% is the growth that you're targeted for exports and around 30% overall in terms of revenues.
Yes.
Will you be able to surpass this, or was this product already included in that guidance?
This was included, madam. This was included in the earlier estimates because we expected this to commission by December end. That is why we included this in our annual guidance.
Okay. Can you give us a sense in terms of what other products you might have in the pipeline which you are probably working on and which you could launch, and by when?
Yeah. When we went public, we announced that there are 8 molecules in the pipeline, and out of which this product, including this, we have already launched 7 products, and one more product we will be launching by March end. And then the further expansion we will be doing at our new site under our wholly owned subsidiary, Shalvi Specialties at Hamirpur. There we will be doing a capex of about 100 crores per annum for the coming 4 to 5 years,
Okay,
wherein they will be making agrochemical intermediates, technical material, and some specialty products based on bromine and fluorine, and some APIs.
So this is the Shalvis, was the subsidiary which received environmental clearance back in December as well, and the stock was very excited in trade that day. When do you expect to start commencement of this particular subsidiary? You said 100 crore rupees. Is that it? Is that all that you'll invest here? And what is the asset turn that you're expecting on that 100 crore rupees?
Yeah, madam, there we would be doing the capex of 100 crores per year for the coming 4 to 5 years regularly.
Okay.
We would be building the plant in block-wise situation, and there we will be generating revenues as the blocks are built up. And we expect the first block to be operational by the last quarter of FY24. And then we will be keep on adding block by block different products.
What is your outlook on margins, sir? Because, you know, FY23 first half, you've been hit quite badly in terms of your margin performance.
Yeah.
It's come down all the way to 24% versus 33% same time last year. And obviously there are headwinds. But what can you guide us for in terms of how these headwinds such as raw material prices, freight costs are doing? And what might your guidance be in terms of the trajectory as well?
Madam, actually, presently we have little inventories of which we bought at a higher price. That is why the margins are slightly low. But as these inventories are consumed, then the margins will improve to 24 to 25%.
Okay, so that is on margins. Last question before we let you go. You said that it will come in at the additional capacity that you did at Sandila. Is that 4,000 tons per annum of capacity that we are talking about? Is it commissioned? And the 70 crore capex that you have planned for expansion at HUL plant in FY23, is that also on track? Will you be able to complete that this year?
No, this 70 crores is at our Sandila plant. The Sandila, that is the Hardoi district. And this present plant, what we have commissioned, is part of that 70 crore capex. And this 100 crore capex we would be doing at Hamirpur under our subsidiary, Shalvi Specialties. That 100 crores will be from next year onwards for the coming 5 years.
Okay, all right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's India Pesticides. The stock is up around 1.7%, low in terms of volumes, but for today they are in focus on account of a new product which they will be launching for the export markets. 100 crore in terms of potential is what they expect. It could go up to 120 to 150 crores as well per year. Well, we need to take a short break, but here's something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investor, that empowers you to make the right decisions with your money. Nothing in life is guaranteed, but many investors fall for the guaranteed returns gimmick. A smart investor always avoids investing in such schemes and is aware that they are illegal and must be reported to the exchange. Any investment in such schemes is not eligible for compensation from the exchange, and hence it is wise to avoid investing with anyone promising guaranteed returns in the securities market. Welcome back. Well, for the Nifty, it's holding at around 18,000. We have the mid-cap index, which is marginally underperforming, so down around 0.2% currently for the mid-cap index. The Bank Nifty also just about managing to eke out gains. Well, let's talk about one particular set of earnings, which in fact surprised the street quite positively. Federal Bank. It came in with a massive 27% rise in its net interest income, which was aided by a jump in the net interest margins. It has, in fact, posted a higher return on assets of 1.3%. I think it's one of the highest that we've seen in around 6 to 7 years. And it is guiding for 1.25% in terms of return on assets for FY23. Abhishek is here with more details on the management guidance and what brokerages are saying about Federal Bank.
Well, the guidance seems to be really strong given the fact that the net interest margin guidance for FY23 has been increased by 10 to 15 basis points. So now they are guiding it in a bandwidth of 3.35% to 3.4% from the earlier 3.25% that they had estimated. And they will end FY23 with an ROA or return on asset of 1.25%. This is despite the fact that they will have branch expansion. Remember that branch expansion always, aids into higher OPEX, and despite higher OPEX, they are guiding for a 1.25% ROA for the full year FY23. So brokerages say that sustaining net interest margin and traction on loan growth will be a key. The bank may raise funds in CY 2023. We had the management earlier who said that they will raise funds in FY24. So stress continues to decline. The overall stress, gross NPA as well as restructured book, that continues to decline. The ROA or return on asset progression is on a fast track. So structurally, the bank is well placed, should see re-rating going from here, and earnings momentum to remain strong. So across brokerages, they remain bullish on the stock. They have increased the target price. The new target price range is between 158 to 175 on the lower end and the upper end respectively. Back to you.
All right, Abhishek, thank you so much for joining us. So that's Federal Bank in focus. From banking, let's focus on insurance sector now. On to our special segment, Quarter Se Quarter Tak. Surbhi today takes us through expectations from the insurance sector in this quarter. Surbhi?
The insurance sector is set to see a rebound in Q3 FY23. This is visible in their retail APE numbers. In Q3, the industry retail APE has seen a growth of 12%, largely led by private insurance players who have seen a growth of 16%, while LIC grew 6%. The total APE has also seen a healthy growth. HDFC Life is back on the growth path with 23% growth on a year-on-year basis. ICICI Pru has posted a growth of 6%, better than most analyst estimates. But ICICI Bank has been going slow on their insurance, and that's visible in their numbers. Max Financial is the only company with negative growth, but the management has guided for a better Q4. Our poll suggests that the value of new business, VNB, will grow anywhere between 12 to 39% on the back of APE growth and also on account of increasing non-par savings in the product mix. Apart from this, the retail protection segment, the one with the highest margin, should also see a comeback in the second half, post a slow first half. On the VNB margin front, life insurance players are expected to see stable to improving margins. The incremental margins will be anywhere between 50 to 400 basis points. HDFC Life's VNB margin is expected to be flattish on account of unfavorable hit from the lower margin business of Exide Life. The other players will see an expansion of 350 to 380 basis points, reflecting higher protection business. The outlook for insurance sector remains robust, and with the underperformance of the sector in calendar year 2022, the current valuations look attractive. Based on FY24 price by embedded value, SBI Life and ICICI Pru appear the most attractive.
Okay, All right, Surbhi, thanks very much for that. So that's on the insurance space and what we can expect for this quarter. Just want to point out a couple of these real estate stocks seem to be doing quite well. Kolte Patil, for example, is up around 3% odd. It's gained around 10% odd this year already, so doing well for that particular counter. And even Prestige Estates is buzzing today. So that stock is up around 2% odd currently and is seeing a good amount of volume traction this afternoon as well. Time for a break now, but Sachidanand Uttekar of Trade Bulls will join in with his trading strategies on the other side. Stay tuned.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, it's been a decent day so far, so it's a good time to get a technical check on the markets as well. Sachidanand Uttekar of Trade Bulls is joining us now on the show. Sachidanand, good afternoon. Thank you for joining us. Well, we are slightly off from the highs, but still there's nothing to complain considering that Nifty is still up around 100 odd points. What do you think will the next move on the Nifty be? Will we consolidate around these levels, or the last 1 hour of trading session will prove to be very different from what we are seeing right now?
Good afternoon, Sonal. Sonal, absolutely right. And I think, the way Nifty has been holding on to the support area around 18,000, I think there's a good, headroom which is still available on the higher side. What we're expecting is that the Nifty should scale towards the 20-day exponential moving average, which is placed around 18,060, and eventually extend its move towards 18,100 during the day. So I think the constituents are doing well. We have L&T, which is scaling near its 52 or lifetime high. We have HUL, which has been doing good. The HDFCs have already seen a good short covering rally. So probably it could be Reliance, which could start contributing from here on. And that's why we believe that the Nifty could scale towards that 18,100 mark during the day. So we are advising long positions when it comes to Nifty. The stop loss should be placed at around 17,920 from here on. And the intraday target could be somewhere close to 18,100.
Okay, well, just hold that thought. We do have the Bank of India numbers. We just have the profitability numbers where it is a growth of around 12% odd on a year-on-year basis. So it's coming at around 1,151 odd crores. Remember, yesterday Bank of Maharashtra posted what was a very good set of numbers from the entire PSU banking space. So let's see whether that kind of asset quality momentum would be maintained by something like a Bank of India. NII is up quite significantly, so it's up around 64% on a year-on-year basis. That is the net interest income. And the gross NPA has improved quite significantly on a Q-on-Q basis. It's coming at around 7.66% versus 8.5% on a Q-on-Q basis. So good going in terms of at least the parameters that they've reported as of now. Remember, most of the PSU banks already had a very good year in 2022. We have seen some amount of profit booking which has taken place. So let's see how much of this good news is already factored in. Sachidanand, while we wait for more details for Bank of India, what would your overall call be on the PSU banks?
Ekta, I think already they have displayed a very strong rally, and if you look at the data from December itself, we are seeing more of profit booking. If you look at the PSU index, Nifty PSU index itself, we are seeing a good amount of divergence on the weekly scale, wherein the index is failing to sustain near that 4,500 mark. So even right now, if we see an extended move due to the result season, probably that particular extended move may not sustain, and probably we may see more of distribution, going forward. So right now, it is better to book some profits when it comes to PSUs and wait for a decline to re-enter.
Okay, so you are advising to quickly book profits in the PSU banking space. Quickly, Sachidanand, can you tell us what are your individual technical picks?
Well, Sonal, I think the major contribution should be from Reliance, and that's why we believe that after a 4 days decline, we are seeing signs of a positive divergence when it comes to its 30 minutes data. We are expecting a quick bounce back towards that 2,500, 2,520 kind of a zone. So we are advising building long positions when it comes to Reliance with a stop loss at 24.55 for a target of around 25.20. And on the sell side, I think M&M Financials has broken down from below its 15-day support zone of around 230. If you look at the opening itself, it's a classic open eye formation. The negative crossover on its 5 and 20 is compelling us that there could be fresh momentum which would be generated and can be continued. So for a target for around 222, fresh shots are advised in M&M Financials with a stop loss at 233.
Okay, all right, Sachidanand, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So on an absolute basis as well, BOI's gross NPA as well as net NPA is improved. We'll wait by for the details with regards to slippages. The stock is currently reacting negatively to its numbers, so maybe the devil would lie in the details, but prima facie, based on what they've reported, it seems to be an okay set of numbers. Remember that BOI has risen quite significantly in 2022. It was one of the big outperformers in the entire banking space, and there were brokerages such as Credit Suisse which had upgraded BOI last year as well. They had upgraded it to outperform from an underperform rating. So there's possibly a lot of that optimism already factored into a stock such as Bank of India. Right now, these are the figures which are flashing on your screen. Time for a break now, but on the other side, Manisha Gupta will join in with Kunal Shah of Nirmal Bang Commodities in our Commodities segment. Stay tuned.
All right.
Welcome back to Halftime Report. Joining us now is Nirmal Bang, Kunal Shah from Nirmal Bang. I'm so sorry for that. Kunal, hi, welcome. We were just having some fun in the break, and that's what's taken us all over the place. But I'll start with the metal prices, and we've seen constant gains into this one. Actually, in January 2023 until now, we have seen a higher single digit that is, and a double-digit gains as well for some of these metals. So whether it's copper, aluminum, zinc, tin, we are standing in strong gains onto this one. Multi-month highs actually. Would you say that much of the China factor and the fact that the Fed might raise interest rates by just about 25 basis points, all of that clearly has been factored in by now?
Yeah, so hi Manisha. Well, I'd like to explain it in detail basically what's going to happen in metals and what has happened. Number one, what has happened is China reopened trade. Remember, China is accounting for the 40 to 45% of the global metal consumption. So whenever economy like China opens up after COVID lockdown of almost 6 months, the pent-up demand is so much that obviously metal prices are going to respond. But like you said, on other side, there is a talks that Federal Reserve may not increase the rate aggressively, looking at the inflation number and all. So these are the two narratives which is going on in the market. But the third one, no one is talking about. The third one is right now, Fed is also reducing its balance sheet. There's so much money have been printed over the last 2.5 years. Almost $4.5 trillion have been printed by Fed, and out of which $500 billion have been already removed in form of selling their bonds in the market. So in last 5 months, the Fed's balance sheet have shrunk from $9 trillion to $8.5 trillion. But now going forward, they are saying that for next 12 months, they are going to continue with this shrinking of their balance sheet, which is not very positive for metals on the long run. So right now we are enjoying the Chinese reopen rally in most of the metals, but perhaps 2 months down the line, we are going to see all metals will gradually go down, because more than the rate hike, the bigger story, the bigger narrative for the market going forward will be the reduction of the Fed's balance sheet. And if they are continuously now withdrawing money, and let us say their balance sheet gets shrunk by $1 trillion, obviously markets are going to feel the liquidity is going to get drained, and all the commodities will feel selling pressure. So I think once China again goes to the holiday next week, I think we are going to see most of these metals are going to cool off right now. I am not very, very bullish on metals from the fundamental point of view because of the balance sheet reduction by Fed, and that will drag down metals. So this rally, I think it's a bit overdone right now, and we are going to see from next week onwards, or perhaps from this week, prices may soften. So I have a contra view right now. Copper looks quite tempting to go short on 765, 766 on MCX. You can go short 750, 740 should be the target. And I'm not very optimistic from present levels when it comes to metals. We've seen the best on account of China. Okay. I think the pain is in the store.
Okay, all right. Kunal, Manisha, thank you so much for taking us through that conversation. That's all about metals. The markets have fallen slightly from the highs. So we'll do one thing, we'll slip into a short break. And on the other side of this break, we'll continue tracking markets and stock-specific action. Stay tuned.
welcome to our continuing coverage here from Davos 2023. It's a very cold morning, so thank you very much to Bob Moritz and Sanjeev Krishnan of PwC for joining me here today. Gentlemen, I know it's cold. I'm going to keep this as brief as possible. For the benefit of our viewers, PwC put out its 26th annual Global CEO Survey yesterday, and very quickly, just to capture the headlines from the survey, 73% of the CEOs polled believe that they will see a global economic growth decline over the next 12 months. This is the most pessimistic outlook in over a decade that the PwC Global Survey has put out. Bob Moritz, I want to start with that. Through the course of the pandemic in 2020 and in 2021, the mood was completely different. CEOs were still optimistic about growth. What explains this significant departure where you have the most pessimistic outlook in over a decade?
Let's remember that the CEO survey is focused specifically on comparison to last year. So last year, coming out of COVID, we had an uptick. We had significant confidence that prior year was difficult. It'll be better this year. This year is going to be harder. The three things that are driving it being harder this year to see that growth: macroeconomic volatility and the disruption that we see, the combination of macroeconomic implications to interest rates and inflationary pressures, particularly the supply chains and the like. And last is geopolitical pressures now that are actually implicating the global economy in a big time way. So those combination of factors are really causing that pessimism on the economy itself. The question is, how do CEOs manage through that?
You know, I'll get to the management part of it in just a second, but let's talk about inflation and interest rates. I mean, this is an era of high interest rates and high inflation that many CEOs who are in the hot seat today have not experienced. What is that going to mean in terms of how they navigate through this? What is it going to mean in terms of expansion, investment, private capex? What do you hear?
So what we'll probably see is first a real hard focus on cost and managing those costs as best they can, taking inefficiencies out of their organizations. They are going to try to protect as much as they can the human capital. Why is that? Because they see attrition staying the same. Even in a slowing economy, those with skills are going to be very valuable and very wanted by employees around the world. So you're still going to have to pay wages, benefits, and actually upskill the talent. The other thing that's going to happen is you're going to start to see some bankruptcies. Those organizations that were able to ride the curve, so to speak, and ride that wave, higher interest rates means they're not going to have access to free money, for lack of a better word. So we'll see bankruptcies. We'll see restructuring of debt quite a bit. And we'll see some organizations sell off businesses to create some value to pay that debt down. We'll see other organizations take some risk and actually say, hey, there's an opportunity to maybe out-execute my competition. So M&A will trickle through just in different ways around the edges of portfolios.
You know, it's interesting because you talk about insolvencies moving up. You're also talking about the possibility maybe of zombie companies and others falling by the wayside on account of the higher interest rate environment. But you're saying that companies at this point in time, and I'm caveating that, at this point in time, are not talking about laying off people, are not talking about wage correction either. So what we're seeing happen in the tech industry, you don't believe that that is going to be a secular trend?
So what you see right now is around the world, 60% of the CEOs are saying, I don't plan to do this as of today. But what you are seeing is across certain sectors, a little higher getting to yes to that answer. Chemicals and consumer, in particular globally, definitely are starting to potentially go in that direction. If you actually go a little bit deeper, in the US, you will have a higher proportionality of CEOs in the tech industry and the financial services industry that in fact are doing those headcounts because they are trying to get ahead of those issues, and especially when you look at the size and scale of those organizations in terms of what they're doing around the world.
I want to talk about, you know, different parts of the world, and let me start by talking to you about the US. Mixed opinion. Many CEOs that I've spoken to, some do expect the economy to move into a recession, albeit a shallow one. Others believe that we're probably going to miss out on one. What's the expectation specifically as far as the US economy is concerned?
So the US economy has got a degree of resiliency with it, and I think they're focusing primarily on how is the consumer situated, how are they doing in terms of their purchasing power and their debt ratios, and they still feel pretty good that they can work their way through that while we're watching the macroeconomic fiscal policies coming out of the Fed and the like. So the confidence level is generally good, with a warning sign that people are paying attention to, and a preparatory mindset, which is I got to get ready, be better prepared, and cut costs as much as possible, redesign my supply chain and my business processes. So you'll see structural transformation in the U.S., but the world's depending on it, and there is a solid foundation for it to actually say we feel good today it's a worry about things tomorrow.
You know, I want to talk about China because that is one of the X factors that everyone here in Davos is talking about as well. Reopened much faster than was expected. There seems to be some softening even as far as the regulatory crackdown on different sectors is concerned. What's the expectation? Because there is one view of anywhere but China, but that's not what you're saying.
No, we're actually seeing a little bit of opposite. You pointed already to some of the changes that have happened in China, the opening up, the combination of some of the policy changes that President Xi and the administration have changed to allow for that domestic agenda to come back to life again. And I think that's going to be very important, both in terms of the stability of China itself and getting to positive GDP growth, which it'll have, but also what role will China play in the world in terms of the investments they're making. Let's remind ourselves they were playing a big global role with their Belt and Road Initiative. And as a result, you want to see that come to life as well. So that's going to be a positive in the world today. It comes through in the CEO survey as well. That CEOs are seeing an opportunity in China, but they're going to do it differently. I'll come back to that. And second, the CEOs in China, much more positive compared to others around the world.
Yeah, I would imagine that they're banking on the fact that there is a rebound, you know, and that it will impact the domestic economy. But specifically on global CEOs, and the expectation was that given everything that's happened, especially with the closing of the economy through COVID, as well as the geo-economic tensions, that global investors will now think twice about investing in China, or we may shy away altogether from investing in China. You're saying that's not the case?
No, we actually still see China as an investable opportunity, but we are seeing management teams that are already there or wanting to be there doing it in different ways. They're reorganizing themselves in China for the benefit of China domestic consumption, and then maybe separately what they do in China for then the rest of the world. So this way they have maximum flexibility and maximum optionality if in fact things go up or down in a significant way as they look ahead.
Okay, let's talk.
Welcome back. Well, in our special segment Value Add today, we're going to put the focus on the entire railway sector. There have been a slew of order inflows for railway companies in the last few months, and the one in the limelight today is the 26,000 crore order, which is won by Siemens. Vivek is here on how the order wins have shaped up in the past couple of months and how the railway theme as a whole is playing out.
Well, that's right. So putting into context, especially as you mentioned, you know, the large order win that Siemens has got. Now, Siemens got a 26,000 crore order win, and this is for a locomotive project in India. Now, putting this into context, especially for the own, order book as far as Siemens is concerned, the order book at the end of FY22 was 17,200. So this single order win is actually larger than the entire order book that the company carried at the end of FY22. So which is why at this point of time, what we're doing is we're trying to analyze the opportunity that the railway capex has. So what we've done is we've divided into three major parts. The first part, of course, is the locomotive opportunity. You know, the government has been talking about Vande Bharat trains. So this particular opportunity size is almost at 1.6 lakh crore, and this will happen in various tranches. Who are the likely beneficiaries? So, BEML, Siemens already one of the order winners. You also have Alstom. This will be the unlisted part of Alstom, Titagar Wagons, as well as Medha Server. And also you will have some of the other ancillary beneficiaries as well. Now, talking about railway PSUs and where do they stand, remember, what do railway PSUs do? They actually do the infrastructure, they do EPC, they are project management consultancies, as well as provide services. So names like RVNL, IRCON, RailTel, RITES, and IRCTC will be the key beneficiaries. And thirdly, very important to watch out what is it that the budget has in store for these names. So Nomura is anticipating a 29% year-on-year increase as far as the railway budget itself is concerned.
Okay, Vivek, thank you so much for explaining that to us. So definitely railway sector is in focus. To take this theme forward, we are now joined by Umesh Chaudhary, who's the MD and CEO at Titagar Wagons, who will speak about how big this opportunity is for the sector and for the company as well. Mr. Chaudhary, good afternoon. Thank you so much for joining us. Well, as my colleague said, especially in the locomotive segment, it's a 1.6 lakh crore of opportunity that we are looking at. For yourself at Titagar Wagons, how big is rail as a part of your order book, and what is the opportunity size that you are looking at in both, say, Vande Bharat and the non-Vande Bharat part of rail order book that we are talking about overall for the industry?
So, very good afternoon. Thank you for having me with you. As your colleague just mentioned, that the railways are actually going in for a quantum jump. It's a completely new dimension that the current government has kind of accorded and provided to the railways. And if we really break up the railway opportunities into two or three aspects, one is, of course, the infrastructure aspect, which is the track and signaling. And the government has invested over the last 8-9 years substantially on the track and signaling and is continuing to do so. But that's not really where our company comes in. Our company comes into the rolling stock, so which is whether it's the freight rolling stock or the passenger rolling stock. And in the freight rolling stock, the government has, with the introduction of the Gati Shakti program and all of that, the railways have now targeted to move 3,000 million tons by the end of 2030. And this locomotive order that we just spoke about, which has been given to Siemens, is actually preparations towards achieving that 3,000 million ton target. And obviously, it gives us a great deal of confidence and hope that that with the locomotive orders being there, the wagons orders have only to follow. Even figuratively, the wagons are following the locomotives, so the orders also should be followed. So that's as far as we did get the single largest freight wagon orders in the history of Indian Railways last year, where our company got an order for almost 8,000 crores, 24,000 wagons, which was the single ever largest order bagged or placed by the railways to any company. On the other side, on the passenger train side, as again was shown in the screen, that we have participated with BHEL. In fact, we are the only Indian consortium. So we are the only true Atmanirbhar or Make in India consortium that have participated in the Vande Bharat opportunity. This was a 200 train opportunity. And the announcement last year was for 400-500 Vande Bharats. And we are expecting that this is not going to stop here. It's going to be maybe more than double of that. So, this tender is yet to get finalized. It's yet to open. But I believe that the opportunity is so large that there is enough for every company. And if every company comes to support the growth initiative of the railways, there is going to be a win-win situation. That
if you could just give us a sense in terms of what we can expect on an absolute basis in terms of order wins in 2023 calendar year versus 2022. If you could just put it into perspective for us, maybe percentage, maybe absolute value.
So, it's difficult to predict this because we are waiting for the budget allocation to see. I mean, we'll see that in the next 2 weeks' time. But what our expectations are is that considering that the locomotive orders have been finalized and the tenders that have already been announced or in pipeline, I would say that in terms of passenger train, the delta is going to be infinite because there was no passenger train that was purchased from the industry in the last several years. And the tender that is already been floated for the Vande Bharat, the 201, is valued at anything between 70 to 80,000 crore. And there is another 200 train tender which has already been floated, which is yet to be opened. So, in terms of the overall opportunity, I would say it is going to be more than 2-3 lakh crores in terms of the rolling stock itself.
Okay. All right, Mr. Chaudhary. We've completely run out of time, but this is going to be a conversation which we will probably revisit in the next couple of days as we run up towards the budget as well. Thank you very much for joining in and talking to us. So that's Titagar Wagons, very positive in terms of the rail order inflow that we can expect. For the markets, there's definitely some amount of weakness which has taken place incrementally in terms of the mid-cap index, 0.5% lower currently for the mid-cap index, and the Bank Nifty, which is down around 0.4% as well. So definitely some amount of weakness coming in. The Nifty also slipping below 18,000. With that, it's a wrap from Sonal, myself and the entire team on Halftime Report. Thanks very much for watching Business Lunch. Up next.